The nation's most popular investment talk show is Mad Money.
Big fan of the show.
It's one guy talking stocks, droning on and on.
I'm as mad as hell, and I'm not going to take this anymore!
And it should make you mad, as in angry or crazy, because you need to hear from a variety of market sources.
Of course, the more the merrier!
You need to get a wide range of ideas. You need some balance. And you need to hear something different just to stay excited about investing in these wild times. This is Money Life Market Call. Different experts every day talking stocks, funds, and more.
You had me at hello, tier.
With experts telling you not just what they're buying and selling, but why. Who cares if it's not the most popular show?
Maybe you didn't have any friends.
It won't make you mad.
This is an outrage.
It will make you smart.
Oh, yes. And one of the smartest stock pickers I know is Brent Wilsey. He is the president of Wilsey Asset Management. And I make the point that he is a smart stock picker because Brent, very disciplined in his approach. And what's great about his approach is it is definitely one that you can emulate. You can sort of take a look at the numbers and go, wow, this makes sense to me. I would do this. And that's part of the fun. Now, I will warn you, because we have a number of you in the audience who tell us, when you listen to us on podcast, you speed us up. Well, if you want to make sure you get Brent's methodology, you're going to want to slow us down and listen to us at regular speed, because even at regular speed, Brent is so excited when it comes to talking about stocks that he goes a little faster than the average bear. Now, that said, if you want to get more information on how he does it, if you want to take a look at his newsletter and all the things he does, he's at wilseyassetmanagement.com, and he's on Twitter at Brent Wilsey. But right now, he's back on Money Life, and I'm always pleased to say, Brent Wilsey, welcome back to the show.
Chuck, good to be here.
Let's talk about that methodology. First, it is numbers-based, but you look more at a couple of key numbers that maybe other guys don't focus on quite so much.
Yeah, and it's funny, Chuck, because everybody says, oh, the market's expensive and so forth. And what you can look at is that you can actually find companies that are trading, at the lower, the 52-week range. So you don't have to buy the whole market at the high price there. But when you do that and you find that company that you think is a good price, you got to take it to the next step. You got to say, well, what does that business do? And then what am I paying for the earnings, the sales, the book value, and the cash flow of that company, and compare that to the industry average, because these are valuation ratios that you're paying for the company. They should be lower. And if the company pays a dividend, find out how much the company uses of their earnings to pay out that dividend. Also look at the growth rates. Are their sales growing quarter over quarter, year over year? And don't forget about the earnings growth. Are they really growing their earnings quarter over quarter, year over year? And very important as well, so many things are important, don't buy companies that are financially weak. And by that I mean look at the balance sheet. Look at what's called the current ratio to see the capability of the company to pay off their short-term liabilities or short-term assets, and make sure you don't buy high-debt companies that if things go the wrong way, they get off file bankruptcy. That's no good. And very simple, and I wonder about this many times, is the company making a profit? Check the profit margin. Also check the return on equity. And look at how efficient the company is. Are they doing good with the receivables and the inventory? Are they turning them over nicely? Or are they stuck with inventory they can't get rid of, and that's going to hurt their earnings going forward? And then use the analyst. You can always look at the mean of the analyst, and you get an average earnings per share going forward, a year, 2 years sometimes, to say what's the mean of the analyst think this company will do. And you're not on your own. You can do this and get a target sell price. And I use 16.5 times forward earnings for a target sell price, because that's the 40-year average, and everything I do, I try to go to the average. I don't try to get too excited and try to be the guy that gets the highest, amount, because usually that's the guy that ends up, losing on his investments.
Is it for you always about those averages as to where a stock is, so that, in other words, if you wind up seeing a stock and it's mispriced or it's priced to give you some sort of a bargain, do you care at all about, hey, is it a quality company? Is it a business that I'd want to own forever? Or is it all in the ratios regardless of what they do?
A great point there, Chuck, because you do have to care about the company, because you might find some great numbers and so forth, but what if you're buying a Polaroid camera or something that is going to be obsolete down the road? So you do have to look at the business, make sure there's going to be demand for the businesses down the road, but you have to understand what you're buying financially, as well as what the business is that you're buying.
Okay. Now, in today's market, because you look stock specific, do you look at the market in general as being, overpriced, tough to find those values? Or is it just a case of, hey, under any circumstances, when you follow the numbers the way you do with that kind of methodology, there's always going to be something to buy?
Well, I got to quote Warren Buffett here, and he says it's not a stock market, it's a market of stocks. And you go in there and you can find companies, and that's why I think it's so funny. People say, oh, the market's expensive. Well, that means some are high, you're paying a lot for those earnings, but there's some companies that they are not high, and it's a time to buy them. They're already going through their correction of 10, maybe 20% decline. You will step in, buy those companies, make sure, again, they're fundamentally strong, and then look at where you'll be 12, 18 months down the road. I think most of the time you'll do pretty well.
Okay. Well, let's talk about a couple of names that stand out to you right now. What are some of the things that have come through the screens that, for you, are in the sweet spot?
Well, let's talk about the thing that's getting beaten up right now, and that's energy. And I look at TransOcean, symbol is RIG, and this is a company that had a high of $55 a share. Right now, you can pick this company up for $31 a share, which is just, it's on sale. I mean, look at the valuations right now. You're paying for the book value of this 80 cents on the dollar, and that's tangible book value. No intangible assets, a book value. You get a 9.7% dividend right now. And yes, their sales are only up 3%, earnings only up 8%. They've got a good balance sheet. They got a current ratio of 1.7. Their debt to equity is only 62%. And looking forward, the mean of 34 analysts, a lot of them say for the year ending December 2015, you're looking for a earnings of $3.04. And gosh, Chuck, if you put a multiple of just 15 on that, not even the 16.5, you get a stock price around 45, a very nice gain from the $31.16 here. And it's not going to happen tomorrow, next week, but look at what oil does. And we know that oil goes down, and what does it do? It turns around, goes back up because of a shortage.
Okay, so that's TransOcean, ticker symbol RIG. What else stands out to you?
Well, there's one I'm looking at, Chuck, and I worry about this company a little bit because of competition. That's where we get back to understanding the business. And the company is Big Five Sporting Goods. Now, this had a high of $20.25. The stock right now is around $9.45. I think it's a good company, obviously, you're in the industry of sporting goods. Here again, you're paying for the tangible book value 1.116. The industry is at 4.7. You get a 4.2% dividend. Their sales are down 1.2%, and their earnings are down 28% year over year. But this company only has a debt to equity of 37%, so they're not stuck with debt. What is hurting them is the big, behemoth here, Dick's Sporting Goods, coming into their territory and taking some business. But they are unique because they're a smaller sporting goods store, and there is a niche for them. When you look at their earnings going out to December 2015, the mean of 6 analysts say, well, they're around 94 cents, what they're looking for. Right now, the company trades at 10 times forward earnings. That's very cheap compared to the S&P around 17. So Big Five looks like a pretty good retailer. You might see some fluctuations here, but I like the company. We haven't bought the company yet, but I keep watching it. It is on my watch list.
Big Five is ticker symbol BGFV. You know what we haven't talked about is your sell discipline. Is it simply, hey, I got what I expected, that 16 times number, and I got what I thought I was going to get out of it, and now I'm out? Is it we've disappointed on numbers? What is the sell discipline?
And actually, I tell people when they come in for an appointment and so forth, when I meet a manager of money, I say we never sell at the absolute top or buy at the absolute bottom. I mean, that's kind of foolish to think we're going to do that. But I'm okay getting out at 16.5 times earnings, and there's been times we get out, at $20, $30 a share, and all of a sudden, oh, gee, it went higher. That's okay. We made a good profit on that money. I then sell that company. I then look for a company trading at, 10 times earnings. So it's okay to do that. And everybody wants to get the top price, and we have done that. But it's luck. And I'm not going to say, oh, I was so smart. No, it was luck that happened.
So what's something that you sold recently and why?
Oh, gosh. But it would be the fact that, it hit 16.5 times earnings. Okay, I just did think of something. It was Take-Two Interactive. We sold that probably, I'm going to say 6 months ago. The Game Maker. They reached 16.5 times earnings, and we sold and we got out. Well, the stock since then hasn't done a whole lot. But when things hit that 16.5 times earnings, there's no emotion to it. It's not like, oh, but they could do this, and, oh, this might happen. Nope, 16.5 times earnings. That's the average of the last 40 years. I'm happy with the profit I make. I'll take the profit, and I'll find a company trading at, again, 10, maybe 12 times forward earnings.
So that's Take-Two Interactive, TWO, the ticker symbol there. Now we're going to find out how you feel about some ticker symbols that my audience is particularly interested in.
Hold it.
You got to know when to hold up.
Or fold it.
Know when to fold up.
It's Hold It or Fold It time with my guest, Brent Wilsey. He is the president of Wilsey Asset Management in San Diego, California. It's wilseyassetmanagement.com on the web, and he's on Twitter at Brent Wilsey, and worth following because it'll let you know when he's posted something on his website. You can go get a look at his commentary, some of his stock picks, and things along those lines. Now, Hold It or Fold It is where we put our guests to your test. And if you want to participate directly, you need to send us your name, your hometown, and the ticker symbols you are interested in. Send that to chuck@moneylifeshow.com. Our first request today comes from Gordon in Downey, California. He wants to know about Aluminum Corporation of China. It's an ADS that trades on the ticker symbol ACH.
You know, it's funny about this. This is an aluminum producer, and gosh, the miners and the metals and so forth, they've just been beaten up. When I looked at miners, we bought one before. It's like, and they just keep going down. Same thing with this one here. The stock doesn't have much of a range. I mean, the high's like 1280, you're around 1065. But gosh, I looked at this company, it was not very good. I mean, you had a price to book here of 1.6, which is okay. But then you look at the earnings, and they were down like 2,000% year over year. Revenue was down 5.6%. The debt of this company, 312%. That means that your debt to equity is 3 times. It's like if you had a house worth $1 million, you owe $3 million on it. That's not a good position to be in, especially if things stay slow. And what makes it even worse, Chuck, you go forward, you look at the analysts, there's only 2 of them, which is not very many, but only 2. Based in the year ending December 2014, the company's going to lose 6 cents. Gets not much better in 2015. They're going to lose 2 cents. You're buying a company that's losing money. I'd say stay away from this company. No sense in buying a company that's losing money.
This looks extraordinarily bad.
That's a sell or an avoid on Aluminum Corp of China, ticker symbol ACH. Mark in Mitchell, South Dakota wants to know about Southwest Gas. That's SWX.
Now, here's one that actually looks okay here. I mean, the high for the stock was 56. Now you're around $50 a share, and they are actually a gas company here. You look at the valuation ratios, they look okay. You got a current P around 17. You got a price to book around 1.4. Get about a 3% dividend. They've grown their sales 5%. The balance sheet, a little bit risky. If you own this company and you're holding it, you want to make sure you watch the debt, because right now it's about 95%. Gets above 100%, I start getting worried. They got net profit margin about 6.8%. And going forward, the mean of 9 analysts saying the year ending December 2015, looking for earnings of $3.15. So you got a stock price here, oil price somewhere around 60, 65. Not enough to just jump in and buy it, but you still got some growth left here. So if you have it, hold on to it and watch it closely.
Hold it if you've got it, but don't buy more on Southwest Gas Corp, ticker symbol SWX.
No money changes hands today.
Josh in Petaluma, California wants to know about Navigators Group. That's NAVG.
Now, here's one I get a little bit excited about here, Chuck. I mean, you got a price around $63 a share. When I looked at, what this company does, they underwrite insurance on the ocean marine and property and casualty and so forth. So it's an insurance company is what it really is. Got some good valuation ratios. You got a current P around 11. Price to book only 91 cents, so it means you're paying 91 cents on the dollar for the tangible book value of this company. They've grown their sales about 7% year over year, earnings up 17%, good balance sheet, debt to equity only 27%, and the company has a net profit margin around 8.3%. Going forward, the mean of 5 analysts saying the year ending December 2015, you got $5.22 per share, put a multiple of 16.5 on that. You get stock price around 85 or so. A nice gain from the $63 per share it trades at now.
That was a buy on Navigators Group, NAVG.
Would you mind stepping aside? I've got a purchase to make.
Tony in Las Vegas wants to know about Tompkins Financial Corp. That's TMP.
Here's another company I get a little bit excited about. I mean, they're high at 52. It's pulled back a little bit to 45. They're a financial services type company, so sometimes they're a little bit different. But you get some good valuations on this company. You've got, again, a current P around 12. You've got a price of sales around 2.8. You'll also get a 3.6% dividend. So while you're waiting for the stock to go up, you get paid a nice price for it. They've grown their earnings 40% year over year. Their balance sheet looks pretty good. Debt to equity is on 96. That compares to the high debt to equity for financial companies, because they're a little bit different accounting, of 328. They got net profit margin of 23 versus 18.5. The mean of 4 analysts say going out to December 2015, you'll see earnings about $3.50. That gives you, again, a stock price somewhere around 55, 56. You got about a 30% potential gain, and they have something called a PEG ratio, which tells you how much you're paying for the future growth of the company at 1.64. I like a PEG ratio anything under 2, 2.5, like the company.
That is a buy on Tompkins Financial, ticker symbol TMP.
Could we please buy now?
Last, Joe in Frankfort, Kentucky wants to know about TransAlta Corporation, TAC.
Here's a company that kind of looks when you started because they were high at 14, now at 10, and people have to be careful because they say, oh, I'm going to great buying here. No, you got to check the fundamentals before you move on because the fundamentals don't look that good on this company. I mean, you've got no PE ratio. You got a price to sales looks okay. You get a nice dividend. This will attract people because, oh, I'm getting a 6% dividend. Be careful because remember, boards and companies can and do cut their dividends, and you have no dividend and a stock price that falls. Earnings are down 168% year over year. There's something going on behind the scenes here. They've got a lot of debt to equity 140%. Their net profit margin, well, that checks in around a minus 0.08. And going forward here, you see the earnings estimates by the mean of 6 analysts looking for 38 cents a share. Well, you put a multiple of even 20 on that, you get a stock price at 8. Stock's at 10. So right now, this stock's trading around probably 20 times earnings, more expensive than the S&P 500, more than I want to hold it. This company is definitely a sell at these levels.
That was a sell on TransAlta Corp, ticker symbol TAC.
Put that one on the psycho list.
And while we put that one on the psycho list, well, one of the guys on our great list, a guy that we know we're going to have back every couple of months just because of talk like this one, is Brent Wilsey. He is the president of Wilsey Asset Management in San Diego. Brent, it's always great to chat with you. Thanks so much for joining me on Money Life.
All right, Chuck. Well, good to be here, and I'll look forward to the next time.
Absolutely. And if you don't want to wait for the next time to learn more about what Brent's thinking, well, check out his work at WilseyAssetManagement.com and follow him on Twitter. He's at Brent Wilsey. All right, just a little bit more to go on the October 9th edition of Money Life. Let's cross the finish line together right after this message.